Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now, after what was a welcome long weekend in many parts of the world, including here in Singapore, we're looking ahead at a fairly important week for financial markets after a relatively quiet one. Specifically, we'll be keeping a close watch on three things this week. The first is in the US, which is set to release the key CPI inflation data for June. Now, regular listeners will recall that this remains a central data point for financial markets, given the question of whether inflation peaks or not continues to be a key driver of Fed rate expectations, which, of course, in turn, continue to be a key driver of both equity and bond markets. Now, the consensus this month is not looking for inflation to peak, with the Reuters consensus forecast looking for a slight rise in the headline inflation number to 8.8%. However, as is usually the case, there's likely to be a lot of scrutiny of the detail in search of any silver linings. Now, these could be forthcoming in the form of a slight reduction in core inflation or slight reduction in the monthly increase in prices. Now, actual inflation prints notwithstanding, we would draw some encouragement from the market's inflation expectations. For example, if we look at the five-year, which many of you know with expectations of 5-year inflation in 5 years' time, a key measure of the market's inflation expectations, this number is close to returning to 2%, which is a level we last saw all the way back in late February as the inflation surge first kicked off. Now, overall, this is supportive of our view that the Fed is ultimately likely to deliver largely on what is already priced by markets, or potentially a little bit less than that, though we'll most probably first need to see a sign of a peak in actual inflation before the outlook starts to brighten. Now, a second factor we'll be watching this week is the US earnings season, which kicks off in earnest with majors in the US financial sector leading the charge this week. Now, as we discussed in Friday's Through the Noise podcast, earnings expectations have not yet followed the S&P 500 lower, and the focus is very much likely to be on corporate guidance on whether the likely weakness in Q2 earnings has room to extend into the rest of the year, which could cause full-year earnings expectations to be revised lower, or whether a rebound is in the offing. Now, for the financial sector itself, a key focus is likely to be how slowing growth for financial products is balanced with the benefits from higher interest rates and bond yields. Recall that in terms of sectors, our preferences continue to be for energy, where the current pullback is likely to be temporary given a still tight demand-supply balance, financials, which should benefit from higher bond yields, and the healthcare sector, which we see as relatively defensive and relatively less sensitive to the broader macroeconomic outlook. Third, we'll be keeping a close watch on renewed risks in China. Now, equity markets stumbled there yesterday amid a small flood of bad news. We had renewed fears of COVID lockdowns amid a rise in cases and testing in Shanghai and Guangzhou, a closure of all non-essential businesses in Macau due to COVID risks, and the imposition of fines on key technology companies for failing to make proper antitrust disclosures on prior deals. Now, this week, the focus is also likely to be on the release of Q2 GDP growth data on Friday. While GDP growth is normally a backward-looking indicator, there's likely to be an unusual level of scrutiny on the Q2 data as markets seek to gauge the impact of COVID lockdowns on full-year economic growth. Now, we remain positive on Chinese equities, while COVID lockdowns are admittedly a key risk to watch closely, as an avoidance of a scenario where closures return to the kind we saw in Q2 means market weakness is likely to be temporary because these are balanced by the policy focus, which continues to be firmly focused on supporting economic growth. So overall, watch inflation in the US, but it's the start of Q2 earnings that could create opportunities in our preferred sectors in the US, while in China, we'd be biased to use any weakness to add exposure to Chinese equity markets. Now, as always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.